The market moves in 4 different ways: consolidation, expansion, retracement, and reversal. Now, we can identify these different types of market profile through 3 different types of dealing ranges. In this video, I'm going to break down the 3 different types that I use in dealing range theory, or DRT for short. So let's jump into what a type 1 dealing range is. Now, firstly, I've discussed each of these types of dealing range a lot more extensively in the DRT series, which you can find for free right here on this YouTube channel. But this is going to be more of a foundation lesson and what each type of dealing range looks like visually. So firstly, type 1, as we can see here, this is going to be an expansion or a retracement type dealing range. And generally, this is going to be a continuation profile. Now, this will be your classic higher high, lower low type trend continuation. So in this example, say we're going lower, we retrace higher, we drop lower again, retrace higher and drop lower, each time making lower lows and lower highs. It's the easiest type of dealing range, which is why I've labeled it a type 1 dealing range. The type 2 dealing range, now this is going to be a reversal profile. Ideally, we want to anticipate type 2 dealing ranges forming, and we should have already established the higher time frame draw on liquidity and what the underlying market narrative currently is. But as a rule of thumb, you're looking for equal highs or relative equal highs above the market and equal lows or relative equal lows below the market. In this example, I'm going to use a bullish type 2 dealing range where we have relative equal highs that reside above the market. We see the market drop lower, and then we have a sharp reversal to the upside, and then a market retraces higher back to the equal highs or relative equal highs residing above the market. For those of you familiar with algorithmic price action concepts, you will see this as a market maker buy model. I'm going to do a whole lot of teachings on the market maker models on this very YouTube channel and how we can combine this with dealing range theory. But for now, I'm giving you the basics and the foundations in this video. Now, the final type of dealing range is our type 3 dealing range. This type of dealing range is our consolidation profile, where the market will stay inside of a tight range. Notoriously, they are harder to trade, although I do have students who prefer type 3 dealing ranges. Personally, they're not for me, but understanding where they form, how they form, and being able to identify a type 3 dealing range is extremely important to understand things like directional bias and draw on liquidity. Now, obviously, these are very crude diagrams. I have here actual price charts which depict each of the different type of dealing ranges. As you can see, a type 1 dealing range here where we have lower lows and lower highs in a downward trend. The type 2 dealing range here, we have the relative equal lows resting above the market. Price turns around over here and then reprices higher back for the buy side liquidity above those relative equal highs. Did I say relative equal lows? I meant relative equal highs. And then the final type of dealing range, the type 3, you can clearly see here that price is being held inside of a consolidation market. Now, let me get a little bit deeper into this and help you understand where each of these different types of dealing ranges sit inside of a buy or sell program. Essentially, that's how the market moves. Buy and sell programs from a higher time frame down to a lower time frame. But everything starts with consolidation or a type 3 dealing range. And this is very important to understand. The main reason for this is because a type 3 dealing range is designed for one specific thing. It's to engineer buy side liquidity above the consolidation and sell side liquidity below the consolidation. I have a whole separate video on type 3 dealing ranges right here on this YouTube channel where I go into more detail on how we can trade them. But in this case, what we must understand that the market needs liquidity, and therefore every buy and sell program is going to start with a type 3 consolidation dealing range in order to engineer this liquidity in the market. Breakout traders are going to place stops above the market when price breaks to the upside, and stops in the form of obviously sell stops below the market when price breaks to the downside. Now, generally what will happen is we will see the market manipulate usually higher and then go lower first, or it will manipulate lower, clearing sell stops, run higher, clearing buy stops, and then continue the move down. In some instances, it will stay inside of a range where we have a defined high and a defined low, and it will consolidate inside of the range, moving from extreme premium down to extreme discount. Again, I explain all of this in that type 3 dealing range video. Now, once we have identified a type 3 dealing range, again, it will help if we understand where the market is obviously likely to reprice to. For example, if we have a sell side liquidity pool below the market and we anticipate price to drop lower, we're waiting for something specific to happen here. And that's going to be when price drops lower, closing below the consolidation or the type 3 dealing range low. Now, a close below this gives us the green light. It indicates that the algorithm wants to spool price lower to an inefficiency below the market, or like I said, a sell side liquidity pool. Once price moves out of this type 3 dealing range, here we can anticipate a type 1 dealing range forming, where we have price retrace higher, often back into the consolidation around the midpoint. We then see the market reprice lower, again, in the direction of the draw on liquidity. We'll then see another type 1 dealing range form. Again, these type 1 dealing ranges, these are all dealing ranges that are moving with expansion and retracement, where the algorithm is spooling price to a particular target. And like I said, in this case, we're going to use an example of a sell side liquidity pool below the market. Now, the missing element here is time. When time aligns with price, and I'm going to do a whole lot of studies on time, so make sure you like, subscribe, and follow this channel. That's probably not right. When we have time and price aligning, and we see the market change directions over here and sweep above a short-term high, this is significant. This is a break in structure where we have been inside of a sell program lower. Now, when this event occurs after we have raided a pool of sell side liquidity below the market, it indicates that the market is no longer inside of a sell program. We then anticipate a buy program to unfold. In this case, we can clearly see the equal highs above that type 3 dealing range. And again, we're going to have buy stops in the form of retail liquidity above those highs. When we see this turnaround, we can now anticipate price running higher, and this is what would be our type 2 dealing range. If we see a type 3 dealing range form and then we see the market reprice lower, we can trade in the counter trend direction, but that requires a little bit more experience. In my opinion, if the higher time frame draw is higher and then we have equal highs, it's better for us to wait for this to occur, where we raid sell side liquidity and or an inefficiency below the market, and then see the market turn around like we do here. Now, I have a whole model here on the DRT model, again, for free on this YouTube channel, which gives you all my rules for entry and how I actually use type 2 dealing ranges. Now, when this occurs, and we've seen now a clear type 2 dealing range form, we can anticipate another type 1 dealing range where we have an expansion towards those equal or relative equal highs and that type 2 dealing range high. We can trade inside of the retracements here. So as the market retraces back inside of that type 1 dealing range, we can enter positions, and I prefer this over the type 1 dealing ranges inside of the sell program. Although I will still trade it, I will reduce my risk in half because it's a counter trend trade, and I will reserve my maximum risk for the buy side or the buy program, which is aiming for our type 2 dealing range highs. Now, eventually I would offload my positions above these highs, and this is exactly what smart money is doing. They're pairing long positions over here with the retail sell side liquidity, and they're offloading those positions back above equal or relative equal highs in the form of a type 2 dealing range and selling back to the willing buyers above the market. So they buy at a lower price and sell it back at a higher price. And essentially, this is how we want to trade. We want to trade the way smart money are trading. Now, let's get into a few actual chart examples over here. So Here we have a type 3 dealing range. You can clearly see that we're here inside of a consolidated profile, and we have our highest high inside of the range over here and our lowest low inside of all of this range right here. All of this price action is contained inside of that type 3 dealing range, from the high down to the low. So we can here define our dealing range high and our dealing range low. The midpoint of this dealing range is something known as equilibrium, or I call the 50 DRT level. Now this is the fair price between the highest price and the lowest price inside of a type 3 dealing range. Notice how price will consolidate around this fair price. And generally inside of type 3 dealing ranges, we will see it move from the extreme of the range down to the low of the range. And again, often it can sweep the high and sweep the low, but still stay inside of this tight range. Now it won't leave until it's time to leave the range. And generally that will happen by the way of a high or medium impact news economic driver. Again, I explained this in my type 3 dealing range video. Now price here is fractal. So what we see here on this higher time frame dealing range, we can see here closer on a lower time frame dealing range. And if we zoom into this, we can again see another type 3 consolidation on a lower time frame dealing range. The point is, this whole process here is fractal from the higher time frame down to the lower time frame. Now, what we're waiting for here is for price to close below that type 3 dealing range low. Once we get this close here, this confirms that price is ready to leave this consolidated market and enter a type 1 dealing range, where we are anticipating price to expand lower after making a new dealing range low. We then see the retracement higher. In this case, we have this fair value gap. We have to include that small volume imbalance there as well. And then we see price again trade lower, expanding below the market to form a new dealing range low. Now here we have again another smaller minor dealing range from this swing high down to this swing low. Now note what happens here. Price consolidates and stays here inside of that smaller dealing range, and it's consolidating below this type 3 dealing range low. Now already here you can see that above the market we have the initial consolidation, which is our type 2 dealing range, and above the market we have all of these highs in close proximity with that type 3 dealing range high. So we have something here known as layered buy side liquidity. So inside of all of this consolidation, again, this is going to be another type 3 dealing range, which can occur when we have traded below an old swing low and the underlying market narrative is bullish. What's happening here is smart money are accumulating long positions using all of the retail sell side liquidity below that type 3 dealing range low. And they're going to offset those positions to the willing buyers above the type 2 dealing range high and that type 3 dealing range high. Again, we're going to have buy stops in the form of retail liquidity above those highs where smart money will buy low and sell high. And essentially this is exactly how we want to trade. We want to trade in the same way as smart money. As we move along here, we can see how prices ran higher and traded through the short-term low. So we have clearly a break in market structure. And when this happens, we should anticipate a type 3 dealing range forming where price retraces lower back inside of the range low to the range high. Now in this case, we have traded through and closed above the equilibrium of this dealing range, or that 50 DRT level. And it's really done it in a very explosive manner. So when this happens, we really do not expect or anticipate a deep retracement back inside of the range. Furthermore, we have a balanced price range here where we've had sell side delivery here and buy side delivery here. And you can clearly see here how the wick drops into that balanced price range, but the body is failing to close any lower. Again, indicates that we want to see higher prices. And again, this would be in line since we have a type 2 dealing range with layered buy side liquidity above the market. Again, price now runs higher for that buy side liquidity. We form another dealing range here. We can use this as a dealing range low, and we have this as a dealing range high. Now this is a minor dealing range inside of the parent dealing range from the swing low down here to the swing high up here. Now, the reason we can use that as a dealing range low is because we've already eaten into that buy side imbalance below the market and we've moved away from a balanced price range, right? So this is indicating that price doesn't want to drop any lower. We then see the market retrace back inside of that dealing range. Again, here we drop below around that equilibrium level. And if you look to the left over here, we have our first presented fair value gap after raiding buy side and turning around. So this fair value gap here is going to be a very important fair value gap, and we anticipate it offering us support. Again, you can see here how the body of that candle didn't want to close any lower, and then we see the market again expand higher back above that initial high that was made above those type 3 and type 2 dealing ranges. So what we have here is a type 3 dealing range where we undergo accumulation. We have a type 1 dealing range that expands lower where we have our manipulation back below the lows. And then we have a reversal with our type 2 dealing range over here. And then we have our distribution back above those highs after smart money has accumulated longs inside of that type 3 consolidation below the market. This is essentially how the market operates. Accumulation in the form of a type 3, expansion in the form of a type 1, and distribution in the form of a type 2. The market is very limited in terms of what it can do. Consolidation, expansion, retracement, and reversal, and they all fit within the narrative of the 3 different types of dealing range. When you can understand where they form, how they form, anticipate what price is likely to do next, and understanding higher time frame market narrative and algorithmic order flow, it makes it very, very easy. It really does take out a lot of the guesswork, especially when you combine DRT levels and dealing range theory with these types of dealing ranges. I have a whole video, again, a whole video series actually on this YouTube channel called the DRT series. I highly recommend you check that out if you haven't done so already. If you want more information about algorithmic price action, then download the free ebook. You can click the link below called Market Maker Secrets, and I'll also send you a free webinar where I break this down in a little bit more detail with a few more timing elements and really give you a masterclass in algorithmic price action. If you found this video useful, please like, subscribe, leave a comment, and let me know what you want me to teach in the next video, and I'll see you soon.